Is your organisation's revenue at risk? Hi, I'm Jacqui Shaw, a financial consultant with the Community Business Bureau, and I thought we could have a bit of a chat together about this today. It's a pretty important topic as it can sometimes come down literally to the financial survival of your organisation. By understanding the risks around your revenue streams, you'll be able to implement appropriate mitigation and monitoring measures, giving you better control over the financial management of your organisation. So here's some risks to revenue that may affect your organisation's viability. Grant funds. Not understanding your obligations with respect to grants can result in delays to grant payments being received, in turn causing cash flow issues. It could even lead to grant agreements being terminated or not being renewed, resulting in a total loss of this income stream for your organisation. Having accurate and timely financial reporting and acquittal processes in place is part of your organisation's obligation to your funders, and this in turn will reduce some of the risk implications here. Pricing. By not regularly reviewing pricing structures and strategies around fee-for-service and some types of fundraising revenue streams can lead to lost revenue opportunities, losing money on programs, as well as leaving your organisation out of touch with the market you're servicing. Your organisation's expenditure increases on a regular basis. Think about wage and CPI increases, for example. So it follows that you will more than likely need to increase your prices regularly to compensate for various organisational cost increases. Consider the timing of any price reviews and the implementation of such, and what impact this will have on your organisation's financial outcomes for the period. Debtors. Ensure your organisation's debtors invoicing is occurring in a regular and timely manner to avoid delays in the receipt of revenue. Regularly follow up outstanding and unpaid debtors amounts and implement any necessary measures needed to minimise the risk of doubtful or bad debts to your organisation. For example, credit checks on clients or even suspending withholding services if payments are overdue by a certain amount to limit your liability. Revenue diversification. Reducing your reliance on a specific funding source is a good strategy to reduce risk. However, over-diversification of revenue can also be a risk to your organisation. Maintaining multiple highly diverse revenue streams can be problematic when each requires, in essence, a separate business calling for specific skills, market connections, capital investment and management capacity. External impacts. Understand the sensitivities, influences and limitations of any external factors that affect your revenue streams. For example, NDIS controlling maximum pricing charges, competitors driving down pricing, or how changes to government policy or legislation can affect grant funds. If you are working with an external pricing structure in, say, a fee-for-service environment, ensure your organisation understands this structure so that any risk resulting from either under or overcharging can be avoided. Financial fraud. By ensuring your organisation has good internal controls and procedures in place, you can mitigate the risk of fraudulent activity occurring within your organisation. And with respect to these activities, think not just in terms of cash or monies coming in and going out, but also in terms of other organisational property that could be affected by this. For example, fundraising stock, misappropriation of funds, or the misuse of other organisational assets. If you'd like some more information for your organisation on risk, I'd definitely recommend having a look at our video series on risk management. In addition, the revenue diversification and the diversifying your business model videos may also be beneficial for you to watch. Bye for now.